A lot of Canadians are about to get a mortgage payment increase that they never saw coming. Not because rates are going up, not because they made a bad decision, but because they're paying attention to the wrong numbers. In this video, I'll show you exactly what's happening beneath the headlines, where rates are actually heading, and the one mistake I see homeowners make every single day when they renew. Let's go. Here's where the Canadian mortgage market actually sits right now, not what the headlines are saying, not what your bank is telling you, what's actually happening and what it means if you have a mortgage or you're about to get one. There's a lot of noise out there right now. The BOC, bond yields, the Iran conflict, tariff, renewal shock. But underneath all that noise, there are three things happening in this market right now that actually matter for your mortgage. And I want to walk you through all of them. Let's start with the basics. A quick snapshot of where things actually stand. BOC is sitting at 2.25. That's where it's been since October 2025. They held again at the June 10th announcement, their fifth consecutive hold. Prime sitting at 4.45 today. If you're in a variable rate mortgage, nothing has moved. Your payment is essentially the same as it's been for the better part of a year. Fixed rates are a different story. Right now, the best 5-year fixed rate for an insured mortgage is sitting around 4%, variable around 3.35. That's what the market looks like today. But here's what's important to understand, and this is where I see a lot of confusion in the market. Fixed rates didn't follow the BOC down. From June 24 to October 25, the BOC cut rates by 275 basis points, almost 3 full percentage points. Variable mortgage holders felt almost all of that. Their payments dropped. Fixed rate holders barely moved. And the reason is simple. Fixed rates follow the bond yields, not the Bank of Canada overnight rate. Bond yields, they've stayed elevated because of inflation pressures, geopolitical risk, and trade uncertainty. The BOC was cutting rates to stimulate a slowing economy. At the same time, bond markets were pricing in inflation risk from rising energy prices. So what we got was a split market. Variable rates fell significantly, fixed didn't. And right now, with bond yields sitting between roughly 3.1 and 3.3%, fixed rates have actually drifted slightly higher in recent months, even while the BOC has been on hold. That's the environment that we're in right now. Not rates are falling, oh my God, or rates are rising, oh my God. More like this. Variable rates have stayed the same. Fixed rates have had an upward bias. And nobody knows with certainty what the next 6 months looks like. So why is everyone feeling uncertain right now? Let me give you the quick version in my opinion. There are two major forces creating pressure on the Canadian mortgage market. The first is the Iran conflict, the conflict that escalated in early 26, disrupted global oil markets, energy prices spiked, gasoline prices are up in Canada over 29% year over year, and when energy goes up, inflation goes up. Headline CPI hit 2.8% in April, up from 2.4% a month ago. Now, here's why that matters for mortgages. Core inflation, which strips out energy, is still close to the Bank of Canada's 2% target. So the underlying economy, it's not overheating. But the BOC can't ignore what's happening at the gas pump either. And if energy prices stay elevated long enough, inflation starts spreading into other parts of the economy. Wages rise, business costs rise, then it's not just a gas price problem anymore. That's what's got the BOC stuck right now. They can't comfortably cut because inflation risk is real, and they probably won't hike because the economy is shitty right now. GDP went negative in Q1. Unemployment is sitting around 6.6%. This is not a strong economy, so they're holding, which is honestly one of the hardest positions to be in because it doesn't give borrowers a clear direction to plan around. The second force is trade uncertainty with the United States. The CUSMA agreement was up for its mandatory 6-year review this June. Tariffs on steel, aluminum, auto, lumber. About 40% of Canadian businesses expect tariff-related cost increase to be passed on to the consumer. That's inflationary pressure coming from an entirely different direction. None of this is reason to panic about your mortgage, but all of it explains why the outlook feels so uncertain and why anyone telling you exactly where rates will be by the end of this year, it's full of shit. Now here's the part of the story I think that matters most. There's roughly 1.2 Canadian mortgages renewing this year, and a massive percentage of them were signed in the low rate era, when mortgage rates were the lowest in Canadian history. We're talking 5-year fixed below 2%, sometimes well below. Those homeowners are now renewing into a world where the best 5-year fixed rate is mid-4s. That's not a small difference. On a $500K mortgage, moving from a rate around 1.8 to 4 can add roughly $700 per month to the payment. That's real money. And many families haven't truly felt it yet because they've been insulated by the same mortgage payment for the last 5 years. The BOC has acknowledged this. They're aware. Most borrowers have managed the transition, but highly indebted homeowners face reduced flexibility and fewer options at renewal. Most people will be okay, but the households that stretched the furthest during the pandemic years, they're going to feel it at renewal time. Now let me speak directly to anyone renewing in the next 6 months. The way your bank handles your renewal, it's not designed around your best interests. It's designed around theirs. Your lender will typically send a renewal offer around 21 days before maturity. It might even be labeled a special offer, and most Canadians will just sign it. That offer is almost never the best option available. The real renewal window starts 180 days prior to maturity. That's when you can secure rate holds, compare lenders, evaluate strategy, and make decisions based on your goals rather than a deadline. Here's something that most Canadians don't know. If you switch lenders at renewal, you generally need to requalify under the mortgage stress test. If you stay where you are, you usually don't. That sounds like a reason to stay put, but it's not always that simple because if a different lender can offer materially better terms and you qualify, the savings over 5 years, it can be substantial. We're talking tens of thousands of dollars on larger mortgages. The point is this. A decision this important, it deserves more than 3 weeks and a form letter from your bank or your lender. I get asked this almost every day. Fixed or variable? Here's my answer. There's no right answer. A year ago, variable rates were materially lower than fixed rates. The discount was meaningful. Today, that gap has narrowed significantly. Variable rates around 3.35, fixed around 4. There's still a gap, but not the same opportunity it was in 24 or early 25. And here's where the risk sits. Variable rates depend on the Bank of Canada, and right now the next move is genuinely unclear. Some analysts have even started discussing the possibility of rate hikes later in 26 if inflation broadens beyond energy. Not the base case, but it's being discussed. That's new. Fixed rates have an upward bias as long as bond yields remain elevated, which means waiting could mean seeing significantly higher fixed rates rather than lower ones. In this environment, that decision comes down to your situation. Your cash flow, your risk tolerance, your timeline, and your goals. Anyone giving you a blanket answer is either guessing or selling some bullshit. So let's pull this together. Here's what the Canadian mortgage market looks like right now. BOC is on hold at 2.25. Variable rates are stable. Fixed rates have a mild upward trajectory because of bond yield and inflation risk. And the renewal wave is the story of 2026. 1.2 million Canadians. Pandemic era rates meeting a very different world. And the biggest mistake I see people make is treating their mortgage like a passive financial product. Something they don't think about until the bank sends them a letter. Your mortgage is the single largest financial instrument most Canadians will ever have. It deserves an active strategy, not a reaction. That's what I focus on with my clients. I don't start with a rate, I start with structure, cash flow, debt positioning, timeline, goals. Then I find the right mortgage for that picture. If you're renewing in the next 12 months and you haven't had that conversation yet, that's the next step I'd encourage you to take. Comment blueprint and I'll reach out and we'll look at your specific situation together. No pitch, just clarity. And if you found this helpful, share it with someone who has a mortgage renewing this year because most Canadians, they're going to make this decision without understanding what we've just covered. If you found value in this, check out last week's video where I talked about why your HELOC is making you poorer. I'll see you there.